Hello, everybody. Welcome to Friday, another Talk Money with Tom show. Really glad that you can join us today. We are live here from Silicon Valley, and we are here to help you try to improve your retirement, at least in a financial sense. We focus on retirement planning, the asset management that you'll need to take a look at, and of course, the tax planning. You can send in questions now if you would like. This is what we do here on the show is kind of answer questions. And so you can send them in live. Send them an email if you'd like to the asktom at talkmoneywithtom.com address you see on the screen there. Or you can put it in the chat if you're signed in here on YouTube. And we'll try to answer those live. We get questions throughout the week. We get questions at some of our meetings with our strategy meetings with our clients, and we'll present some of those too also. So, of course, we have this channel for a reason. We started this in 2020, just trying to inform people about what's going on. And so you can subscribe to this channel. You can hit the bell button if you'd like to get more content as it comes out on a regular basis. And then, of course, if you'd just like to meet with us and ask us questions directly, you can do that also. So we have our book appointment button up on the corner of our company website. You can get to that website through the link here right on the channel also. So just 30 minutes with Ethan and I on a phone or in person or video or whatever you'd like, and we can maybe answer some of your questions also. So anyway, that's kind of what we're trying to do today. Again, I'm very excited about what we'll be able to talk about today. There's a lot going on. Mm-hmm. There really is. And so I do start off the show each week with a summary kind of what I saw happening in the market this week. And I guess we're going to call this tariff week, really, because that's what's been going on for the most part. That's most noteworthy, at least for the market standpoint. So let me see. Oh, didn't work. Okay. So we're having trouble with our connection here on our visual, but we'll just talk through it. So the stock market hit an all-time high yesterday. Mm-hmm. Right? Again, came down on Monday based on the tariff talk that was going on over the weekend. You're going to start sending out letters to these countries. And on Monday, specifically the two biggest countries that I saw, 25% tariff letter went to South Korea and Japan. Yeah. Right. So pretty major, partners. Now there's been, I don't know, maybe 20 different letters that have gone out altogether, from anywhere from 20% to 40%. Not that far off so far from where we were on Liberation Day.
Yeah, some have come down. Most have come down, but occasionally a few have been up a couple of percent.
Yeah, and we've got a 50% tariff all of a sudden now on copper. It was announced this week, which is actually a really big deal, maybe a bigger deal than the 50% tariff on steel and aluminum. You have, of course, the 50% tariff that's been threatened against Brazil, which is kind of a weird one because they actually they buy more from us than we buy from them.
Yeah, it's unusual for such a large tariff. It seems more punitive than actual for the trade.
Yeah. He's upset about the possible prosecution of the previous administration. Yeah. So I guess the thing that's kind of interesting to me, right? We're re-announcing the tariffs that came in April 2nd specifically, and it drove the market down nearly 20%, right? And today it was down like 0.25% off of a new all-time high that we hit, yesterday, even though we're announcing all of these tariffs that came out. Why would the market be, doing so well in a time frame where obviously, that concern was very acute back in April? Here we are in July, just a few months later, and all of a sudden it's not that acute. So really, the key piece, I think the thing that's changed in that time frame is that Trump has backed off. As a matter of fact, these tariffs that were announced this week are sort of a back off in a way also, because the ones that he paused from April 2nd were supposed to start up again on July 9th, which would have been Wednesday, right? And so that's been pushed out to August 1st. And so now he's, sending out these letters and announcing tariffs. And today actually talked about moving up the base tariff, which is 10% right now, to 15 to 20%. So if you look, there's a thing called the Yale Budget Lab. They do a really good job, I think, of trying to, put together the impacts of tariffs and all those types of things. So right now they're saying that the tariffs that have been announced, and not just talked about, but announced, are an average 18% tariff. Is
Yep.
where we're at right now. Okay, so if you look back to the height of the tariffs back in the 1930s, it was a 19.2% tariff. So we're getting there. I think if you go to a base tariff of 15 to 20% for every country, you're probably going to get up into that 19 to 20
Yeah.
plus percent average tariff. So, we have the same level of tariffs that we have back in the 1930s. And so, the Yale Budget Lab, made some projections. So first of all, one of the things they said, which I thought was interesting, over the 10-year period, the next 10 years, if the tariffs stayed the same, right, even with some demand destruction, they're projecting about $2.6 trillion worth of tariffs would be collected, right? So, we got that budget bill that came through that had about a $3.3 trillion deficit, right? So theoretically, the tariffs could pay for most of that budget deficit. The problem with tariffs historically, especially at these levels, they've never been able to stay.
Yeah.
Because if you look at the impact of 1930s tariffs, unemployment doubled in 12 months. World trade literally collapsed. It went down 66%. It dropped by 1933.
Yeah, I don't think world trade's going to stop. I think just the U.S. may get excluded or isolated out from world trade. A lot of other countries are just looking for other partners to subsidize what would have been traded to America. China's, has traded more this year than previous years.
That's right.
Even though trade has dropped with the U.S.
Yeah, that's an interesting point. So if you look at May for China, the exports to the U.S. dropped 43% this May versus the last May of last year. Yet China's overall exports grew 4.8% in May. So they're picking up the difference. I guess, if you look back at what happened before, you probably couldn't have the U.S. doubling their unemployment rate and all these other things that would happen without having some global contagion. This is true with China or any of these big countries if they really start to have troubles financially. And so I think part of what happened in that 1930s, trade collapse had to do a lot with just the overall economic situation that's happening there at the same time. And so, but the Yale Lab had some things I thought were somewhat moderating in terms of their projections. So, for example, they're expecting the consumer price index to grow 1.9% if all tariffs are pushed through to the consumer, which is a pretty big if. It probably wouldn't be that. There'll be, right now, what we've seen so far is 20% of the tariffs are being absorbed by the exporter. So 80% is coming into the country to be split amongst the businesses or consumers, neither of which is great, right? I mean, so if the businesses paid all of it or some of it, they're going to have less money, they're going to hire less, they're going to do less projects, those types of things. If it goes through to the consumer, especially in a substantial way, they're going to buy less, right, and have less buying power.
Yeah, it depends on the categories.
Right.
Yale Labs is saying that clothing and shoes are going to go up almost 30%. Right?
Yeah, exactly. So it is specific to different areas, right?
Yeah.
I said in their autos would be 5 to 12.7%. The
food is 2.4.
2.4% was projection on food. The overall household would lose about $2,400 worth of buying power on average, and here in the U.S. And so, I think what's interesting though, if you look, because they were talking about like the GDP for 2025 would drop about 0.4 to 0.5 to maybe 0.5%. Again, if you look at where we were last year at 2.3 or whatever, we're still not in a recessionary basis based on their projections as far as that goes. You look at the overall scenario for what's happening. That price increase doesn't scare me as much as it might, right? I mean, we just had CPI go up to 9% in 2022. And so we're at, let's just say, for example, we're at 2.5% to make up a number. And if it goes up another 2%, we're at 4.5%. The market would struggle with that only because, it's going the wrong direction. And it means the Federal Reserve is not going to be lowering rates. And right now, part of the factoring that's coming in from this movement upward in the stock market is the fact that there is expectations for a couple of rate cuts this year, specifically starting in September is what the market's betting on right now. But if you start to see, and this is where we're going to probably see some volatility, if you start to see, that price increases coming up and we're going, away from 2.5 and all of a sudden we're at 3, so it would make a pretty big difference. It's not quite like what we saw in 2022. But the market has already factored in a couple of rate cuts. If you go from a couple of rate cuts to a couple of rate increases, the market's going to have an adjustment to make from that standpoint. So, the thing that people are asking me the most is, why is the market going up in the face of all these potential issues that are coming? Because potentially the deportation of immigrants could affect, agriculture, construction, the restaurant industry, the lodging industry, those types of things. That could create an inflationary impact. You could have an inflationary impact from this big beautiful bill, actually, that's really would start more next year, because that is money that's coming back into the consumers' hands and businesses' hands that could be spent, and so there's a lot of potential inflationary pressure, and so why is the stock market going upward? Well, I think the biggest reason, there's a couple reasons, but there's a whole bunch of pieces that if you take a look. Number one, the people that are nervous about this have been out since April.
Yeah, most of the people have just exited the market.
Yeah, that leaves the other side. So that's what happens when you see these extreme pessimism surveys that we started to see in April. People are selling and getting out at that point in time, and they're likely still sitting out because they're we haven't solved the tariff thing yet, right? So it's still out there. The other reason, there is a seasonality that happens right now. The first half of July, if you go back to 1928 and look at the first half and second half of each month, the first half of July is the best 2-week period, right? First half of a month. And that has to do with what they keep putting in the headline, a wall of money. You saw the same thing last year. A wall of money that comes into the market after the first half. And it has to do with all of these big funds and pensions and what have you, investing cash and rebalancing and those types of things. The average peak going back to 1928 was the 17th of July.
Yeah, and usually you have some softness afterwards for the beginning of fall.
Yeah, I mean, last year, the 16th of July was the top. We dropped, 5 to 10%, as I recall, into August. As far as that goes, it came down quite a bit. So it recovered from that and went on its way. But you do have a lot of things coming together. You have that peak that's possible from that cash flow. You have seasonal softness that happens. September is the worst month of the year. It's really the only month going back that far that has an average rate of return that's negative. And so you're kind of going into that. And now we're starting to maybe see the impacts of some of these, pieces. Right now, if you look at what the Yale Labs was talking about too, they were saying, okay, if you look from January through May of this year, we're seeing about a 1.5 to 4.5% increase on kind of a basket of goods. If you annualize that out, you're looking at 3.5 to 10% increases. That's pretty substantial, so those things are going to start to, they're already going up so far, just since, January through May, but that impact will continue to go, and it obviously doesn't include the, big tariffs that are supposedly going to come on August 1st. So, the other reason the market could be going up is because the market does not believe that these tariffs are going to stay here, right? Because that, and it's been going up ever since basically Trump did the pause. It was like a signal to the market. It's like, oh, if things get bad, he's going to go and make it better by changing it. And that's a big difference. In 1930, tariffs were passed by Congress. Then they kept them in there. It was really hard to get rid of them. And
Do another act.
It went on forever, because it's Congress. Here, it's Trump. And so he can decide to go up or down as far as that goes. So I think that's a big chunk of what's happening here. I will say, for me personally, I'd be a little bit nervous just because nobody can tell. I'll never forget in 2008 with Greenspan and Paulson and the CEO of Lehman Brothers meeting, that picture is still in my mind. And they had just bailed out Bear Stearns with a $125 billion bailout. Lehman was asking for a $150 billion bailout. They were unhappy with the Lehman CEO, hasn't been following their advice. They didn't bail out Lehman, and we ended up with a 30% drop because what they didn't realize was that behind the scenes was $7 trillion worth of credit default swaps that had been sold in a 5-year period. So this is a private market. And so what's going on right now? So whether you think Trump's the smartest person or not, I think even the smartest person would have a really hard time knowing all of the mechanisms that are being pushed around right now.
Mm-hmm.
And so these tariffs can kind of create that situation where something can fail and unexpected things can happen that you can't just then take the tariffs back. It'll be on its own. That cascade could start as far as that goes. I don't know that that's a high probability, but generally speaking, this is not an unusual occurrence. It's about a once every 20-year occurrence where we find out something is falling apart behind the scenes or is under pressure. Private equity, private credit, all these things that are happening. It can be very difficult to figure out what dollar amount's really out there and how that dollar amount is actually placed, and what type of risk might be available in that particular system. So that's one piece. So the other piece is, again, there was a pause this week from July 9th to August 1st. And yeah, we're throwing up all these big numbers, but will they happen? Because one of the things to me, when you look at this week, Trump likes to do distraction things. If he has something that's happening that he doesn't want everybody to focus on, he'll start doing something else that kind of sucks the oxygen out of the air. He's really good at it. And this week, of course, we had the Texas flood, which is a big deal. And then, of course, the Jeffrey Epstein file scenario that's being played out there. And so there's two things that he might not want people to be talking about. And so he starts to go after these tariffs because it's very visible this week, very aggressive.
Yeah, and a lot of the predictions were this week tariffs would actually happen.
Yeah.
And so having an August 1st deadline is just another extension of it. So people are feeling like he just keeps backing off and extending.
That's right. And so does it even matter? You can look at the market. I think the market says it doesn't matter. It doesn't matter that he's announcing all these tariffs, because if he just keeps pushing the deadline back, they don't come into effect. And a matter of fact, they start to, have less impact on like Christmas, which is a big one. So when you get back to August 1st, a lot of companies are buying toys and different things along those lines. And so some of these things can really help if they continue to push that back. And so that's the game that's being played right now. The stock market is feeling fairly confident that, the tariffs that we're talking about, because again, they're the same tariffs we were talking about April 2nd that dropped the market 20%, are now having almost no impact on the market.
Yeah, and that could be the risk adverse investors are out, and only people that are willing to take on risk are still in the market. So they're just see it as it's okay.
Yeah, it's a very interesting time frame. You're trying to basically determine kind of the psychology of what's going on here and what not to. So, we have a 2/3, of our normal allocation exposure to the stock market. So we've been participating in this up movement kind of nicely. We still have that other third in kind of the T-bill area. In hindsight, we'd have been better off just being in there. But I still feel like there's enough red flags, there's enough question marks that need to be answered before we really go rolling out that direction. And let's see what those impacts are. I do believe that even the tariffs that are here now, because we do have a 30% tariff on China, 20% I think has been agreed upon with Vietnam. Got a base tariff at 10%. There's
Canada is 35% now.
Yeah, that's right. Today was 35% announced. They did not announce, though, in that Canada bit, whether the USMCA, which is the old NAFTA agreement, which has currently been excluded, which has no tariff on those particular goods. So, you take the big travel hit that's happened, because the travel industry, tourism here in the U.S. is getting hit pretty hard. The confusion that all this is causing and the cutbacks that people are doing. And, it's kind of interesting because one thing that has happened is people have kind of accelerated some of the purchases. I met with clients this week that just bought 2 cars. They weren't going to buy them right now, but they decided to do that because they didn't want to deal with possible tariff increases that might come on that area. So there's, in a way, the tariffs are creating, more commerce, at least here in the short term. And so I'd like to see, So let's say that we're going to buy those cars next year or, later this year, and all these people are front loading their expenditures. That means there's possibly a gap coming at some point in time. So I think August, September, October are going to be really interesting time frames to see how things go. It's a soft time of the year anyway,
Yeah.
and see if the market can hang in through that. I think that would be very instructional. So anyway, that's where we're at right now. Thank you for joining us for our summary. I look forward to being able to do this again next week. All right, let's start off with our first question.
So, when we're at retirement, there's kind of like a sequence of withdrawals for taking your money out of your retirement accounts. Is there kind of a similar operation or order of operations for saving for retirement? Is there a best way to kind of put the money into your retirement accounts, your tax deferred, tax free, or taxable accounts? And how should I allocate my money into my accounts if I'm not going to retire for another 20 or so years?
Yeah. So once you're in retirement, we have this thing called the optimal sequence of withdrawals, right? Where you should withdraw from first, second, third, fourth. And we've done some shows on that. We've done videos on that. You can find those on our channel. It's a really, really important part of making your retirement work well. And so now the question is the opposite side. Hey, how do we, save? Like, we got all these different options. So I'm going to save X amount, percentage or dollars. Where should I put it? Kind of first, second, third. So kind of an order of operations of saving for retirement. The one answer that comes out all the time, which is very, obvious, is that if you have a match in any one of your retirement programs at work, you want to get that match.
Yeah, 50%, 100%. That's a guaranteed return on your money, essentially.
That's exactly right. So that's a definite. You put the money in and get the match. Just because that you can't get that rate of return anyplace else, So then it becomes sort of an issue of like, all right, I look at it like the three buckets, right? You got the taxable money, which is just money that's in a form that isn't tax deferred and it's not tax free, right? So those are the three buckets. And so where should you put the money? Well, obviously, if you're going to get the match, you're going to put it into the tax deferred or the tax free arena if it's available.
Yeah.
So some companies now have the ability to do a Roth 401k where you can contribute to that Roth 401k and then they put the match into that Roth, right?
The match is taxable, so whatever they match is considered taxable income. So you're putting essentially after tax money into that Roth 401k.
Right. We're pretty big advocates of trying to balance out at least what's in retirement plans, somewhat so with what's outside of retirement plans. So having that liquidity, because we always talk about that emergency fund. So that might be this next place to kind of start, right? So I'm putting away enough money to get my match. And then I want to make sure I have my emergency fund, available.
Yeah, so whatever you feel is your comfortable emergency fund, if that's 3 months of expenses, 6 months, whatever you need to feel comfortable, within a reason, I would say. And then after that, then you kind of decide what, do you go tax-free or tax-deferred, I would say, is the next step.
Yeah, exactly. So this is where Ethan and I differ a little bit, just because if you look at the math, you can kind of take a look and figure out what's the optimal thing. Should I be doing tax deferred like an IRA or a regular 401k, or should I be doing a Roth IRA, which is tax free, right? So obviously the difference is with tax deferred, you get to write that off. So if I have $10,000, that I'm going to save into one of those two vehicles, I put it into a regular 401k, I get $10,000 deducted off of my income when I file my tax return.
Yep.
So, and then obviously if it's a Roth IRA, when you put that $10,000 in there, it does not get deducted from your.
Yeah, and so if you're trying to do like terms, maybe if you put $10,000 into the 401k, but you can only, after tax, it's only $8,000 into the Roth 401k.
That's right. Yeah, exactly. Because I'm going to still have to pay the taxes on that $10,000, and if I'm getting a match, let's say I'm getting a $2,000 match or something, that also ends up as taxable income on my tax return. So I have to pay the taxes now on that asset, for my long-term retirement, say 20 years from now, versus not having to pay the taxes and
Mhm.
just getting it deferred and then dealing with, the taxes in retirement. So just from my perspective, meeting with the clients over the years, I do believe, I think it's important to balance out the math with kind of the enjoyment of retirement. My outlook on retirement is it's super difficult to get there. And our clients have achieved something that most people in the U.S. haven't been able to do, which is
Mhm.
actually have some money
Yeah.
in retirement. And so, it's the same thing. Like, you could go, domestic here, stay in California for your travel, but they want to go to Europe, even though it costs a lot more, even
Mhm.
though the dollar's down. And the reason they're doing that is because they're trying to enjoy their retirement. So for me, I see a retirement that has no tax deferred assets in it as being much more enjoyable than one that has tax deferred assets, even if it costs me some money. Just like I could go to Disneyland or I could go to France, right?
Mhm.
And I decide to go to France. It costs more because it's more enjoyable to me, especially because I don't like standing in lines. But that's another story.
Yeah, I think there's a point where doing a tax deferred account is better,
Mhm.
in a sense that if it depending on when you retire, you could have periods of time where you could do a Roth conversion if you had saved or if you set it up properly, where you're converting at a cheaper tax rate than what you saved when you deferred it.
Mhm.
So that way you're maximizing your tax efficiency.
Well,
But
there's a
that's an assumption you're
right.
making assumptions based on future tax rates that you don't know what could be.
You're,
So,
you're also making an assumption that you can do a Roth conversion because over the course of the time that we've been doing Roth conversions, it's changed quite often.
mhm,
Right now, it's an unlimited income, but it used to have a cap
yeah,
on, if you made X amount. So, obviously, if you're in that gap, for what you retire at 65, you have to start taking money out of your tax deferred accounts at 73, right?
mhm,
And so there's this gap there, and so we often design that gap to be low tax time frame, right?
yeah,
Where you can live off of some of these other assets that you have that don't create as much tax. And then you can convert, your 401k or your IRAs into Roth IRA, a little at a time, kind of filling in a certain tax bracket. Um, but I don't know when that was, but it wasn't that long ago. You wouldn't have been able to do that just because there was this cap of income, which meant that you could only do small amounts. And so that's one of the challenges of
yeah.
trying to
So
figure that out.
you're balancing the idea that you're going to be able to convert, still be able to convert at a cheaper rate. So you don't, you know, rates are at historical lows right now. So is there going to be an increase in tax rates then? So if the idea is that you believe tax rates are going to go up, then paying taxes now is a better idea in a
Mhm.
sense.
Yeah, no, and so then I see that wholeheartedly, but I also have seen some of the issues. So, because when you turn 73, you have to start taking money out of this, account. And sometimes it doesn't matter. Sometimes it does. It really does matter how much money you have,
Yeah.
whether it makes a big difference. One of the biggest problems with having tax deferred assets is if you and your spouse are both working and you're both saving money into tax deferred vehicles. Uh, and then, you're filing joint, your Medicare is set up under a joint, IRMA, what they call,
Yeah.
the testing on how much your Medicare should cost. And all of a sudden, one spouse dies. And now that the other spouse has all of those tax deferred assets in one spot with that one person. And no longer are they filing joint, they're filing single.
hmm
And now they're under the straight, IRMA for a single. Even though the money was really created by two
Yeah.
people, there's one person left who is holding the bag. Good problem to have. Nice big 401k, but they're maxing out what they're having to pay on their, they can't control it. It's coming out because of requirement of distributions, and all of a sudden they're having to pay maximum on their Medicare, for example, and those types of things. So for me, if I have, I'd rather have the pain of trying to pay that tax as I go. I also feel, we're running a monstrous deficit. I wouldn't be surprised if tax rates don't change in some form or fashion at some point in the future. It's pretty low right now.
Yeah.
I'm okay with paying those taxes now with that thought in mind. But I like that tax-free, retirement. I'd rather suffer through it now, make sure that, my spouse or I don't end up in that scenario where all the money ends up in one name. And so, they both make sense. Maybe there's some middle ground there where
Yeah,
you're
you
splitting
don't,
the difference.
you don't have to do.
Right.
Most companies allow you, if
Yeah.
you want to, is to do a split
Yeah,
too. So
yeah.
you don't have to do purely
Right.
Roth or
You could do
purely a
50/50 or what have
Yeah,
you.
and I think having a diversification of the tax deferred and tax free is beneficial, because no matter what, you're going to need some sort of income to live and live life. So if it's a tax deferred, that's okay too. If that portion is, as long as it's not, you're not, because if your RMD is below your expenses, then it's not that big of a problem.
Yes, that's right. And that's fairly common, actually. I think the one advantage of the diversification amongst the two pieces, say a 50/50 or whatever, is that you're actually diversifying tax law and what might change in that tax law, coming forward, so that you can you don't have to guess. You've got money in both pockets, both tax deferred and tax free, to be able to, deal with whatever happens. Maybe they change the Roth IRA taxation rules. You never know what's going to happen going forward. Taxes could go even lower than they are now, for all we know. Tariffs get rid of income taxes. Like, that's what Peter Navarro wants to do. So, as a matter of fact, ironically, the U.S. used to run just on tariffs before we had a federal income tax. That's how they got their money, was tariffs. So, looks like we're trying to get back there. But
Yeah,
we'll see how that goes.
Once you start to fill in whether you choose a tax-free bucket or a tax-deferred bucket, once you kind of hit that 15 to 20% of saving income, any income you save after that, if you had maxed out your tax-deferred and tax-free buckets, you could go to taxable accounts. You could go to paying down lower interest debt. There's a lot of different operations that you can kind of, once you hit that 15 to 20% savings rate, anything excess of that is really up to you what you do with it.
Yeah, I guess if I have a perfect scenario, I'd like to have at least, I get to my retirement and I have X number of dollars. I'd like to have at least 25% of that outside of retirement plans. Just purely liquid. It gives me flexibility. I can't tell you how many times that's come in handy. Or the opposite, when people don't have anything in that bucket, everything's in tax deferred. Tax free within our clients, the Roth really wasn't available enough. Other than the conversions they're doing now, they didn't have the choice that this person has 20 years from now, right? So I guess I would look at it like, okay, I've got my match, I've built up my emergency fund, and now I'm going to go back over to my retirement plans. Maybe I do a 50/50 between, deferred and tax-free. But I do want to keep track of that on a percentage basis and continue to add to that taxable part, so that I'm heading towards kind of at least a 25% in the taxable, and the other money is in these retirement. 75% of retirement plans is okay.
Yeah, the reason you want taxable is any kind of big lumpy kind of expense. Let's say a new car, expensive surgery or something like that.
Foundation on your house, the roof on the house.
Yeah,
those kind
and
of
something
things.
that's just really lumpy, it's really expensive to take it out of an IRA
Yeah.
versus a taxable account.
Yeah, because the brackets are progressive, right? So if I got to take $100,000 out this year for something I wasn't expecting or what have you, I could get hit pretty heavily on the tax on portions of that, versus having that in a taxable account. Even if it's fully taxable, it's a capital gains rate, which is less at the moment than ordinary income. But oftentimes I can get a lot of that money out of my taxable account. I've already paid taxes on it, and I can get some of that out without having that problem. So, and I just say this because in dealing with the clients over the years, there are some clients who have these giant 401ks, right, IRAs now, whatever you want to call them. And very little money outside of that, and it is really restrictive in terms of, and it's just a real pain to get money out of there. It's not fun as far as that goes. So anyway, that's kind of, the overall concept. We look at all three buckets. We try to kind of just contribute, as you can to those three buckets, keeping the kind of overall percentages in mind to kind of get to your optimal place.
You want to think about it kind of like a stool, a three-legged stool. You want to have a balance, because if one leg's too long, it tips over. If one leg's too short, you have the same issue too.
Yeah, exactly. All right, that's a good question.
Does it matter where I keep my emergency fund? Is a money market fund in a brokerage account versus a high yield savings? Does it really matter?
No, I'd say, obviously if it's an emergency fund, it needs to be available. It probably shouldn't be fluctuating dramatically as far as that goes in terms of the principal. And that's where you'll often see them in, checking accounts, savings accounts, high yield savings, those types of things. I would be looking more towards something that paid well, right?
Yeah.
You were talking to me today about what the Charles Schwab
Yeah.
money market pays.
I think it pays like 4.15% right now
Yeah.
for the 7-day yield.
Now, that can change in terms of it can go up, if the rates come down, it would come back down, that kind of thing. It was really low not that long ago.
Yeah.
However, the principal doesn't change. With most money markets, you buy one share for $1, right?
Mhm.
And so, they're pretty safe as far as that goes. And that's a really nice rate of return for something like
Yeah,
that.
so you want something stable that doesn't have principal. You want it to be easily accessible. So you generally don't want CDs at that point unless you do some sort of short-term CD ladder,
Yep.
because you want to have those funds available in case you need that. And if you have to break a CD, sometimes you have to pay a penalty,
Right.
whether it be interest penalty or some sort of or just principal penalty. It could be that, and so you want to kind of avoid anything with lockups, I would say.
Yeah, exactly. I think, there isn't enough money being paid from a CD that is high enough as so if a CD was paying 7% and the
Mhm.
money market is paying 4, I'll probably take the chance to do the CD because maybe I don't need the emergency money, and even if I have to break it, I pay the penalty. I'm way ahead. It could be 5 years from now. However, if the CD and the money market are almost exactly the same, it doesn't work. So, and that's why the money markets are I think, a much better bet than the CDs as far as that goes. That's something to watch. Sometimes those change, but
Yeah, so if you don't have a high yield savings account, but you have a brokerage account and you want to have an emergency fund that you don't want to open another account, you could do a money market fund in your brokerage account.
Yeah.
Just know that you're not really going to touch that for investment, and it just has to stay there kind
Yeah.
of as a
yeah,
protection.
usually you have to kind of buy that money market. So there's a money market attached to your brokerage accounts. Those pay very little,
Yeah.
and that's actually where the brokerage makes some money. But you can often find the ticker symbol for that money market that you want that pays more, and you buy that. And the nice thing about that is it's kind of separated. You can see, okay, this particular money market with that ticker symbol, this is my emergency fund, and yeah, it's in my brokerage account. That's fine. It makes it easy. I don't have to open a new account or anything, and I can, just kind of make sure mentally that I'm understanding what that is, and I can build that up. I can keep adding to it to the point where I want it to be, and that is something to continue to look at towards retirement also, right? It's just how much do you want to have in that, and maybe it's not as high as you'd like it now, so slowly build it up, right? So yeah, it's a good place. All right.
So what's the difference between a systematic withdrawal and annuitization of an annuity?
So an annuity, you give your money to a life insurance company. You can put it into all kinds of different things. Different variable annuity would have all kinds of different investments that you could buy. And then once you kind of have that, you've accumulated it or deposited or whatever. Let's say you need to get income out of that. Well, one of the ways that you can get income out of that is annuitizing it,
Mhm.
right? And so when you annuitize it, there is a huge number of options usually. The one that pays the most is a life-only option, okay? Only on your life. And so what that means is it's going to pay you X dollar amount based on your age and how much money you have in there
Yep.
for the rest of your life. And if you live like 3 months, okay, all that money's gone. If you live 30 years, you probably beat the insurance company because they probably weren't expecting that.
And so the insurance company makes money basically basically, if you have a big enough group, the actuary tables are very accurate.
That's right.
It's just you just have to have enough people.
Right.
And so they're going to have some people that die early. They're going to have some people that live too long.
Yeah.
But in the end, it'll average out.
Yeah, so you can do a joint life, you and your spouse, so it would keep going. It pays less, You could have your spouse get 50% or 100%. All of these things impact, and usually you can ask the insurance company for kind of all of the options.
Yeah, you can have
and
tables.
what the payouts would be. You can get a 10-year certain, for example, which just means that if you die within that 10-year period, it'll continue to pay to your beneficiaries until they get back out what you had at the beginning,
Yeah.
right? And so, that's pays less, all these different guarantees, as far as that goes. But in every single one of those cases, the money that you have in there is no longer accessible to you.
Yeah, you basically give up that contract value for a guarantee from the insurance company to pay this amount for this period of time, or
Right, which I'm not completely object to be honest, because I have clients who, because basically what that is to me is like a pension,
yeah,
right? And so the clients that I have that have nice pensions have they're having a lot of fun.
yeah.
Yeah, you know.
Their market concerns are much lower. They have
Right.
a lot more flexibility.
And because pensions have become so rare, the number of people that are going to have pensions in the future is going to be even less to a certain degree, and probably smaller than some of the older retirees. But so maybe that's a way to kind of do that. However, because the money that you put in there disappears, you better keep it in reason in terms of the dollar amount on a percentage basis of what you're dealing with. I probably wouldn't go past 20% of what I have.
Yeah, but
if
it's nice.
that.
It's nice that usually annuities pay less than the market
Right.
when they do their returns. So
Yep.
the life insurance companies have to make some sort of money. And so,
Yeah, yeah. The
but
insurance company's probably going to win, but you're going to have money coming in when everything's falling apart.
Yeah, you have a stable income even
Mhm.
if the market is is dropping 20-30%.
Right. And so the other way of taking money out of an annuity is what's called a systematic withdrawal. Even during a penalty period, annuities usually have a period where you can take out 10% without any
Yeah.
penalty. And, you shouldn't be taking out 10% anyway. It should be kind of in that 4% range, 3% range. And so what you would do then is you just kind of tell the insurance company, hey, I want to take out, figure out what 3% is or 4%. I want to take out this amount of months per month. And it just starts coming out. And now the valuation of your annuity is going to change depending on, is it a fixed annuity where it's a fixed interest rate, or is it variable annuity where you're investing in stocks and bonds essentially? And so that's the same thing with an IRA or what have you. You set up a systematic withdrawal to kind of, pull that out. And the advantage there is that, if you needed access to that capital, you could get it out.
And then your beneficiaries, let's say you die after only 5 years,
Yeah.
you haven't exhausted the contract value.
Right.
Your beneficiaries still inherit some value from that contract.
Right, yeah.
And then a lot of these companies have made kind of riders that you guarantee using systematic withdrawals. They'll guarantee a certain income for the rest of life,
Yep.
no matter the value of the contract, essentially.
Yeah, they've kind of did this blend thing with these writers where it's sort of like annuitizing,
Yeah.
but sort of like a systematic withdrawal. It's actually pretty nice. Matter of fact, they were so good that they have really reduced the payouts on
They've
those.
reduced the payouts, and they've
yeah.
also upped the charges on them.
Oh, very much so, yeah.
The riders are quite expensive now.
Yeah, that's what happened, because they were a really good deal in 2008, kind of changed that a lot for the insurance companies. They started losing money on those. Once in a while they get it wrong, which was good for the consumer, but they've now increased the cost of those riders to a point where I'm not sure it's worth it, to be honest. I probably wouldn't do it in today's world. But so anyway, that's a good question. It's a really interesting area, income generation. Because the other question that comes up is, should you be withdrawing from that annuity? Because you got to look at all of your assets and figuring out where you should be withdrawing from, first, second, third type of thing. So anyway, that's that. Okay, so good. We are at the end of our show today. Thank you for joining us today. Really appreciate that. Again, any questions that you have, send them in. We'll try to work on them this week and get back here on Friday next week and answer them. Ask Tom, talkmoneywithtom.com. Go ahead and subscribe to the channel if you haven't already. Hit the bell button so you get notified when new stuff comes. And then if you'd like, just set up a 30-minute time with Easton and I. Book an appointment. Our schedule's online, and we'll be happy to talk with you and try to answer some of your questions. So, thank you very much. Appreciate everybody coming today.